In today's video, folks, we are talking about Corsair Gaming. Now, this company makes a lot of different peripherals for your computer, whether it's RAM chips or Elgato streaming supplies. So if you're a streamer on Twitch or whatnot. Well, in today's video, folks, we are going to be looking at the fundamentals of this business, figure out what they're doing right, what they're doing wrong, and find the intrinsic value. As they report their earnings tomorrow, I find it's imperative to try to get ahead of the curve and say, okay, what is the price we're looking to pay for this business? Currently, it's at $15.69, a far cry from their price point pretty much 2 years ago to the date, $43.05 here. So if you bought way back in 2021, you are currently in the red for this business. What is our goal here? Let's find that intrinsic value. So to do that, I'm going to load this up here in the Stock Spec software. Now, this is a tool I like to use that quickly analyzes companies fast and efficiently. Currently, this software is grading the company a 7 out of 10. So that means they're pretty strong on a financial basis based off of their statements that they've reported. They're only getting knocked in 3 different categories. One being the price earnings ratio sitting above 22.5 because we don't want to be paying a premium for those earnings. 2, their EPS growth. Well, technically, there's not enough data because the company's only been public for 3 years and not 5 years, so there's not really a 5-year spread to look at. And their share dilution is actually sitting at 9%, which they're getting knocked for because ideally, sharing is not caring. We don't want to find companies diluting shareholders. Ideally, we want to find companies buying back shares. If companies keep diluting shareholders, it's not the best thing out there, folks. They got to be buying back shares because ultimately when companies dilute shareholders, that access to the profits becomes smaller and smaller and smaller piece of a pie, which you don't want. However, amongst those 3 things that are not looking too good, there's a lot of good things on the table. Current ratio sitting above 1.5, so they have a lot of assets to cover those liabilities. Debt to equities below 50%, which is pretty good. That means they're leveraging their capital through equity. However, the caveat to that is most likely the share dilution, which is where they're pulling their equity from. Now, their net income is going up, free cash flow is up, revenue growth is up, and the return on invested capital sitting at a whopping 17%. That's actually pretty good. Now, turn that over to the company metrics category, and it doesn't look too hot, actually. So, over the last little while, everything's improving. But the trailing 12 months has been getting a little bit roughed up. A lot of negative numbers on the board. One being the return on invested capital that we said. Because look, on average, even though it's 17% here, the trailing 12 months is negative 5%. The free cash flow is technically down by $17 million. So not looking too good there. Net income is also currently in the negatives as well. As well as the profit margin is in the negative too. So this is a company that definitely got hit. I think they definitely had a huge surge during the pandemic years of 2020 and 2021, as people were most likely inside doing Zoom meetings, streaming, stuff like that, where the surge to buy their products and peripherals became grossly inflated. Now, as things start to get back to more normal life, which we're pretty much there, this seems to be a reflection of that. However, what should we be paying for this company, guys? The financials look pretty decent. However, this rocky, this might just be a one-off year. It's so hard to determine with these new companies because look, the company's only been public for 3 years, and in 2 of those 3 years have been really interesting due to the whole pandemic effect. As people were inside, as I said, doing a lot of things, working from home. So going forward, even though it's a $1.57 trillion company, and the next from my historic numbers, even though this company has been growing quick and growing fast, I don't want to go based off those metrics. If anything, I'm going based off the 1-year metrics because take a look at this. The last 5 years, and this is going based off of them being a privatized company, it's 46% growth over the last 5 years. This is going prior. The 1-year growth is 11.85%. So for me, I'm going to take away that 14% growth and maybe stick to 12.5 to try to hover around that. Now, they very well could crush these numbers. However, I don't know. There's a little bit of a speculation here. So I try to stay as conservative as possible, going based off the profit margin and free cash flow margin, sticking within the window here of 4, 5, and 5.5 for the profit margin, and the free cash flow margin sticking with between 0.48% and 2.90. With a price to free cash flow, price earnings ratio on the more conservative side, desired return of 13%. Let's see what the software pumps out for this company here. And if you want to get your hands on the software, folks, follow the links in the description box below. 7-day free trial. I think you'll love it. It's fairly easy to use. There's a video I will attach here, or should be popping up here, of actually how to use the software. And take a look at this. Currently, the stock price is $15.69. Average calculation comes out to be $20.19. At the time of recording this video, and this is with some pretty conservative revenue growth numbers, this might just be a buy all day based off of these numerics here. What do I think? I ultimately, it's, for me, this is tough. For me, this is tough, and to stick to my principles, I like finding companies that have been on the market for over 5 years, because that usually gives you a better sense of where this company lies. And for me, for Corsair, even though it's kind of screaming at, hey, with these conservative revenue growth numbers, this company is a buy, I still feel my gut doesn't tell me that this is the right move just yet. So what am I going to do? I'm going to wait. I'm going to wait probably a couple more years to potentially get into this company, because as I said, the last 2 years have been very shaky for this business. This year might be more of an accurate representation of where this company might head. And ultimately, we were trying to stay as conservative as possible. We're trying to stay as rational as possible. And if you enjoyed this video, hit that like button and subscribe button for more analyses like this. Guys, thank you so much for watching. I will see you in the next one. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.